Can one plan really offer comprehensive life coverage and guaranteed returns? Let's dive into an in-depth analysis on the Tata AIA Sampoorna Rakshak plan and find out in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to take the right financial and investment decisions to reach your financial goals in a more faster and smarter way. But before analyzing whether investing in this policy will be helpful for us in the future or not, let us first understand a few basic details about this policy. So Tata AIA Smart Sampoorna Rakshak plan is a unit-linked non-participating individual life insurance plan. So some of the key features of this policy is that you have the flexibility to pay your regular premium or your limited premium of 5, 10 and 12 years. Choose from 21 funds ranging from equity oriented to fixed income focus based on your risk appetite. You can also safeguard your financial goals through the death benefits in case of unfortunate death during the policy term. There is also something called refund of 2x premium allocation charge, and in the policy years 10, 11, 12 and 13 you also get a refund of your 2x of your mortality charges from the 11th policy year onwards. And there are also tax benefits available as per the applicable tax laws. So these are some of the key features of this policy. Now let's take a look at the main benefits under this policy. So first let's take a look at the maturity benefits. So if you survive till the end of the policy term as a policy holder, you will receive the total fund value including any top up premium you have made fund value, which is valued at the applicable NAV on the date of maturity. And next is the death benefit. So in the case of death of the policyholder during the policy term, then while the policy is still in force, the nominee or the legal heir will get either any of these three options mentioned in the screen. So whichever is highest in value at the time of death of the policyholder, that will be given as a death benefit. So first is that basic sum assured net of all deductible partial withdrawals, if any, from the regular premium fund value or the regular premium fund value of this policy, or 105% of the total regular premiums paid up to the date of death. In addition to this, you can also get some of another option, which is the approved top-up sum assured or top-up premium fund value of this policy, or 105% of the total top-up premium paid up to the date of death. So out of these three options also, whichever is highest at the time of death of the policyholder, the legal heir or the nominee will get the death benefit in addition to this. Next is the refund of charges. As I have already mentioned, you get your mortality charges refunded at 2x. So starting from the 11th policy year at the end of each policy month, so 2 times the mortality charge excluding any underwriting extra and taxes which is deducted in the 120th month prior shall be added to your fund value in the form of addition of units. And there is also something called refund of your 2x premium allocation charge. So this happens at the end of the 10th, 11th, 12th and 13th policy years. So 2 times your total premium allocation charge excluding taxes deducted 10 years prior, that is over the policy years of 1, 2, 3 and 4 respectively, shall be added back to your fund value in the form of addition of units. So these are all the benefits you will get from this policy. So now let us take a look at the fund options and the investment strategies available under this policy. So first, as a policy holder, you can choose from 21 investment fund options with the option to use the enhanced systematic money allocation and regular transfer, which is an abbreviation for enhanced smart portfolio strategy. So your allocable regular premium and top-ups, if any, are invested in one or more investment funds as per your chosen asset allocation and your risk profile. So as you can see, there are 21 funds which are Emerging Opportunities Fund, Sustainable Equity Fund, Multi-Cap Fund, India Consumption Fund, Top 50 Fund, Top 200 Fund, Super Select Equity Fund, Large Cap Equity Fund, Whole Life Mid Cap Equity Fund, Dynamic Advantage Plan, Whole Life Aggressive Growth Fund, Whole Life Stable Growth Fund, Whole Life Income Fund, Whole Life Short Term Fixed Income Fund, Flexi Growth Fund, Constant Maturity Fund, Target Maturity Fund, Small Cap Discovery Fund, Business Cycle Fund, Rising India Fund, Mid Cap Momentum Index Fund and Discontinued Policy Fund. So these options are differentiated based on their risk profile and asset allocation, and asset allocation can either be given in parts to equity, debt, money market or individually as well. So you can choose out of these fund options whichever is convenient for you and invest in. And another is the Enhanced Smart Investment option, which is an investment strategy, and this option is applicable till premium payment term only. So an enhanced smart strategy is not available with the top up premium fund. So the Tata AIA Smart Sampoorna Rakshak policy holder gets the choice between two funds, a debt oriented fund and an equity oriented fund under this option. And you can see the variety of available funding in the table mentioned in the screen. So here the entire annual allocable premium is parked in the selected debt oriented fund before being systematically transferred into the portfolio's preferred policyholders preferred equity fund. So it allows you to enter the volatile equity market in a structured manner. So these are all the fund options and the investment strategy you can choose to invest in this policy. Next, let's just take a look at the various charges that we have to pay under the Tata AIA Sampoorna Rakshak plan, as it is an unit linked policy. So first is the premium allocation charge, which will be deducted from your regular premium. So the net regular premium after the deduction of charges is invested in funds as per your choice. So all this applies to all the charges. So in the premium allocation charge depends on the policy year you are and what is your percentage of your annualized premium. So you can refer to the policy brochure for more details. Next is the policy administration charge, which is a charge of 0.41% of the annualized premium from your fifth policy year, which will be deducted by cancelling units at the NAV from the fund value of the policy at the beginning of each Tata AIA Smart Sampoorna Rakshak policy month. So this charge may be increased by up to a maximum of 5% per annum, which can compounded annually can be subjected to a maximum of 500 rupees per month. Next is the fund management charge. This depends on the fund you choose to invest in. So it can range from 0.50 to 1.20 or 1.35. So something in that way. It can differ based on the fund options you have chosen. So next is the mortality charge. This is charged for providing you with life cover. So mortality charge of the basic policy will be deducted by cancelling units at the current NAV from the regular premium fund value of the policy on each policy month anniversary. So this also depends on the age you are in right now. When it is deducted, you can refer to the policy brochure for more details. Next is the discontinuance charge, which depends on the year you choose to discontinue the premium amount and the premium paying term. There is no discontinuance charge after the fifth policy year onwards, and there is no partial withdrawal charge as well as premium redirection charge. But there is still a fund switching charge, which is because there are 12 free switches per policy year, but thereafter a charge of 100 rupees per switch will be applicable. So these are all the charges from this policy. As you can see, these charges mentioned are relatively high compared to other market linked investments. Premium allocation charges, policy administration fee, and the discontinuance charges act as overhead costs for the investors, ultimately reducing your long-term returns. Next, let's take a look at the advantages and disadvantages of this policy. So first, let's start with the advantages. So after the fifth policy year, a maximum of 4 partial withdrawals are allowed in a policy year. You also have the flexibility to pay additional premiums as a top-up premium, and the sum assured will increase accordingly. You have the option to receive your maturity benefit either in lump sum or in the form of periodical payments over a settlement period of 5 years. You also have the flexibility to customize your product by adding optional riders. So these are all the advantages. Now let's take a look at the disadvantages. A loan facility is not available and the lock-in period here is 5 years, and after the deduction of charges only the net premium is invested for your investment, and life cover is inadequate, and during the settlement term the policyholder bears the entire risk in the investment portfolio. So these are also some potential drawbacks of this policy which you need to carefully consider before choosing to invest in it. Now, as we have taken a look at how this policy briefly works, now let's move on to the analysis part of the video, where we are going to explore the research methodology we are going to use for the Tata AIA Smart Sampoorna Rakshak. So essentially, market linked products come with significant risk, making it crucial to assess the potential returns before investing. So we are going to calculate these returns for which allows for comparison with other investments, which can enable informed decisions. So let's determine the internal rate of return, that is the IRR, using figures from the policy brochure of this policy. So now let us analyze the IRR by assuming, just for calculation purpose, that a 35-year-old male has chosen to invest in this policy with a sum assured of 10 lakhs, and the policy term is 40 years with a premium payment term of 10 years and annual premium term of 50,000 rupees. So at the end of the term, he receives the fund value. So how we are going to calculate the IRR is based on two assumed future investment returns, as this is a unit linked product, so market does influence the returns we might get. So we are going to take 4% per annum for the worst case scenario, while the 8% per annum is for the best case scenario. These returns are not in any way guaranteed and do not reflect the maximum or minimum potential returns you can get from this policy. This is completely for example purpose. So with a worst case scenario return of 4% return, the fund value is 9.03 lakhs, which yields you an IRR of 1.68% as per the Tata AIA Smart Sampoorna Rakshak plan maturity calculator. So a return of 1.68% essentially offers you with no value addition to your investment. So basically, even if you have not invested your money anywhere and just kept your money in a savings bank account all these years, you could have gotten a rate of interest higher than this. And the worst part here is that this return is not even guaranteed, which means it can go even lower than this. And at the best case scenario, at 8% return, the fund value reaches 40.22 lakhs, yielding an IRR of 6.01% as per the Tata AIA Smart Sampoorna Rakshak plan maturity calculator. 6% is a return which is comparable to those of a debt instrument like a bank FD. Even there you can get guaranteed returns of 6 to 7% or 7 to 8%. But here, only after taking so much risk and after investing for such a long time, we are getting a return of 6.01%, which is comparable to a debt instrument, which is not justifiable at all, because the risk and returns we are taking here is not proportionate, which impacts the investment decision. So this imbalance between risk and return is a significant drawback of investing in the Tata AIA Smart Sampoorna Rakshak plan. So alpha generation is a key factor in any market linked investment, but it's notably absent in this policy. Additionally, the life cover provided is also insufficient. So to better understand its performance, let's compare this policy with other investments in the market using the same criteria, but we are going to explore an alternative investment strategy. Rather than combining life cover with market return, we are going to separate them to see if it can lead us to better overall returns. So for life insurance purpose, let us assume that we have chosen to invest in a pure term insurance policy with a sum assured of 10 lakhs, which will only cost you an annual premium of 11,800 rupees, whereas you paid an annual premium of 50,000 rupees there, but here it's only 11,800 rupees. So the policy term is 35 years with a 10-year premium payment period, which is similar to the metrics we saw in the Tata AIA Smart Sampoorna Rakshak plan. So after paying the premium for the 50,000 rupees, you are left with 38,200 rupees for investment, which can be allocated according to your risk tolerance. So basically, a PPF account, if you PPF is a public provident fund, which also has tax benefits, and it is a debt fund, a debt oriented fund, and you can get guaranteed returns of 6 to 7% returns there. And ELSS mutual fund is an equity tax saving scheme, which also has tax saving benefits under section 80C, and it has even for the risk, it is a market linked product, so obviously it has risk, but for the risk we take, if you look at the track record, it has consistently given 12% per annum if you choose to invest in it for long term, like 7 to 10 years. So according to these calculations, we have chosen a PPF, public provident fund, to compare the debt with a debt instrument, and ELSS mutual fund to compare with an equity component. So a PPF account requires a minimum contribution of 500 rupees for 15 years. Given the 10-year premium payment term, adjustments were made in the final year contribution. You can see the PPF's final maturity value is 44.42 lakhs with an IRR of 6.30%, which is slightly higher than the returns we get in the best case scenario of the Tata AIA Sampoorna Rakshak plan. But for the ELSS fund value, the pre-tax maturity value is 2.24 crores. But after accounting for the capital gains tax, the final maturity amount is 1.97 crores, which yields a post-tax IRR of 10.78%. So despite being a debt instrument, the PPF offers higher returns than the 8% best case scenario of this policy. And the ELSS fund, even though it is also a market-linked product like Tata AIA Smart Sampoorna Rakshak plan, it provides a superior risk adjustment adjusted return, and it also offers the flexibility to withdraw funds as needed without any restriction. So the liquidity and the inflation beating returns of these alternatives are significant advantage compared to this policy. So what is the final verdict from the analysis on the Tata AIA Smart Sampoorna Rakshak plan? So if you look at the market related investments, it is typically intended for long term financial goals, which provides investors with the opportunity to take on higher risk. But however, if you look at the Tata AIA Smart Rakshak plan, which is classified as a high risk investment, its potential returns do not justify the level of risk involved. So this could definitely impact your wealth accumulation effort. Inflation can actually increase the cost of your goals over time, potentially leading to a shortfall in the funds needed for your future objectives. And also, this policy has a high agent commission. Additionally, the sum assured by this plan is insufficient. So all these factors makes it likely that investing in this plan could derail your financial plan. So what is a better alternative for securing your future family's future is investing in a pure term life insurance policy for affordable premium, even for a higher coverage. So these policies provide essential support in terms of uncertainty. So to achieve your long-term financial goals, it's crucial to develop a solid investment strategy that can effectively navigate the financial landscape for you, like by investing in a diversified investment portfolio which has both equity and debt in it, and make it customizable according to your risk tolerance and your investment needs. But before making any careful financial decisions, carefully evaluate the product and see if it suits you. But if you need any further clarification and you need professional guidance, then you can definitely consult with a professional like a certified financial planner who can help you create a personalized financial plan based on your time horizon of your goals, the risk tolerance of yours, and the life financial goals. Based on all these factors, they can definitely customize a financial plan perfectly to suit your unique needs and help you in the long run.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.